So investors do need to tread carefully when it comes to discounts. Unfortunately, there are no scientific hard and fast rules for telling you when a discount is attractive and when you're looking at a value trap. No 1 year, 3 year, 5 year average can be proven to show when you should be buying or not. However, for investors with a long-term view, let's say over 10 years for what you're investing in, really NAV returns should dominate what you get as an investor. So discounts should become less important. However, you need to do your research. There's no two ways about it. Often boards give good clarity on where they want the discount to be and how they're going to try and defend it. So that's something you need to be aware of. And then you want to be able to distinguish between market conditions and individual trust issues. So generally speaking, investment trust discounts in a certain sector or area will move in and out with appetite for the asset class. In that case, you want to be buying when the discounts moved wider because appetite will come back. However, there are obviously cases which tend to be more to do with individual investment trusts where a wide discount is an indication of problems, whether that be on the shareholder register or some other reason. These are the minority of situations, but investors need to be able to do the research to be sure what they're looking at. So we think this is actually a good time to be picking up UK exposure on valuation grounds. However, if you're worried about current volatility in the markets, it might be worth looking at some of the trusts which offer diversified returns. So in this space, BH Global and BH Macro are particularly interesting at the moment. They've both had very good 2018s after weak periods previous to that, simply because of the return of volatility in markets. So BH Global would be the more diversified multi-strategy fund, whereas BH Macro is a bit punchier. But the principle is the same in both cases, that they look to find opportunities where trades offer a great upside but limited downside, and that could be in either direction. Markets go up, markets go down. So they've done very well in 2018, and if markets continue to be volatile in 2019, we'd expect them to do the same. Another interesting trust is Gabelli Merger Plus. Now this trust buys and sells the shares of agreed merger situations. So what they're doing is they're picking up almost free returns here because the only risk they're taking on is the risk that the merger falls at the final hurdle, so be that shareholder approval or regulatory approval. But in return for taking on that minimal amount of risk, they get relatively certain returns. And this is something that you should be able to grind out returns in this strategy, even if the markets are weak or the markets are falling. It's not dependent on market direction. So that's another interesting strategy to consider to diversify your portfolio. It's worth saying at the beginning that predictions are a mug's game. At the beginning of the year, I thought that the trade spat between the US and China would be a lot of hot air and would blow over. I thought it was Trump bluster, proven to be completely wrong. I think most people were wrong about this as well. So with that to one side, which areas are interesting at the moment? I would say that on a value basis, the UK is looking very interesting. Obviously when asset classes are out of favour, when sectors or geographies are out of favour, there's always a story as to why it'll always be out of favour and you should never buy in. But this is when you need to be looking to build up your exposure. Whatever happens with the outcome of the Brexit negotiations, the UK will continue to be a major world economy with world-leading businesses. And there will be good returns from those businesses, whether it be this year or next year, who knows. But at certain these valuations, we think it's time to be building up exposure, probably drip feeding in. We like Haverforth UK Smaller Companies Trust for this. This is a trust with a very strong value mandate where the managers have been finding a lot of value in certain companies which have been indiscriminately sold off because of their UK exposure. With a more large cap or all cap mandate, Keystone Investment Trust, run by James Goldstone at Invesco, is an interesting option. Similarly, he finds some really beaten up valuations in good businesses where the only justification is that they're exposed to the UK consumer. So as long as we don't get Armageddon following whatever Brexit deal we get, this should be, for investors with a long-term view, this should be a good place to invest. So we'd be drip feeding in there. On a real deep value basis, maybe Eastern Europe is worth looking at as well. The index there is trading on a PE of just 9 times. Obviously there are all sorts of political issues, with Putin facing off against the West repeatedly, but there's good demographic potential in some of those countries. There's some great international companies, and we think this is over a long period of time, this could be a good place to invest. Bearing Emerging Europe has invested very successfully in this part of the world and has yields around 5% at the moment. So we think one particularly interesting area at the moment is the private equity fund of funds. Now the discounts here have really widened out since May as markets have been weak, even though NAV returns have continued to be good. So the average discount on the private equity fund of funds is now 20%. These businesses tend to be relatively insulated from the broader economic environment. They're more secular growth stories than cyclical. And at current valuations, we think they're looking attractive. One particularly interesting trust is ICG Enterprise. This is a diversified portfolio with the managers have a very clear mandate to look for companies with limited downside, and we think at current levels it's looking very attractive.